How would you ever know how to value an online business unless you know the market for that particular type of business model, that price range, and that niche in industry? Hi, I'm Jaryd Krause. I'm the host of the Buying Online Business podcast, and today I'm speaking with Ryan Hutchins, who owns a business valuation firm, two plumbing companies, a stripping company, a multi-location bakery, and a multi-location pizza restaurant. Today we talk with Ryan about how he was in finance, doing financial DD for a business valuation firm, how he went out on his own to create his own business valuation firm, Peak Business Valuations, and then move on to investing in his own businesses himself as an investor and also owning the businesses. In this podcast episode, we talk about so much around where do sellers go wrong and buyers go wrong when they're valuing a business to either buy or sell, what can happen between two parties that wanting to purchase a business. We also talk about how a seller might undervalue their business when they're selling their business as a strategic acquisition versus selling their business to a wider market of people that might be buying their business the first or second acquisition. We also talk about how SBA loans are approved and how Ryan and his team do a lot of SBA business valuations and what they look for. We talk about how important working capital is, how much working capital you need for a e-commerce business, how much working capital you need for a SaaS business to get approved to acquire one of those businesses with the SBA. We also talk about the differences between valuing an e-commerce business versus a SaaS business. We also talk about the risk between an Amazon business and an e-commerce business off Amazon and the variations. We talk about the larger risks in online businesses versus the risks that most buyers focus on, which aren't as important as the larger risks, which are the primary risks. So there's so much value in this podcast about how to value online business. If you're looking at buying a business, this is definitely for you. Also, make sure you get my due diligence framework on how to take the guesswork out of buying a business. It's free. Thousands of people have used it. I'm sure you're going to love it. It's what I use. It's what all my clients use. Prevent yourself from buying a lemon. Go to buyingonlinebusiness.com/free resources. You can get it there. Let's dive into the pod. Ryan, welcome to the Bob podcast. Thanks for your time.
Well, thanks for having me, Jaryd.
Yeah. So you've been valuing businesses. You've started Peak Business Valuations. How long ago did you either buy your first business and when did you start valuing businesses? Did you start valuing businesses first or acquire first?
Ooh, good question. So I'll give a background. So I started as a tax accountant working for Deloitte in San Francisco. And after I got my CPA license, I left and joined a business valuation firm in 2015 in Utah after being in San Francisco for 2 years and started working at a business valuation firm that primarily focused on SaaS companies and stock option issuance. And after going from a work environment of working 70 to 90-hour weeks, only expected to work 40, I just learned the whole business model, how to sell in theory, and then started my own valuation firm in August of 2018 after just working in valuation for 3 years. And I bought my first company. It's a water softener company. So it installs and services water softeners and ROs and anything water quality. And bought that business with a couple partners in 2021. And from there on out, bought one or two businesses each year.
Cool. Congratulations on starting in 2018. And then, one business a year since 2021, right? So you're up to 3 businesses now?
Yes and no. It's more complicated than that. So I'll go over my track record. So bought that water softener company, which I kind of classify as more residential plumbing in 2021. 2022, put money into a concrete contracting company, which filed for Chapter 7 bankruptcy in the States last year.
Oh, okay.
So I lost my shirt on that one.
Mm-hmm.
Granted, I'm still wearing shirts. And then in 2023, gosh, this is all running together. In 2023, invested in a holding company that owned a catering business, a multi-location bakery, and then a multi-location pizza franchise.
All right.
And we recently just sold the catering business to fund further expansion with the bakery and the pizza chain.
Cool.
So I've learned quickly that it's much easier to invest in other people than it is in companies, because if the people running them aren't solid, you're not getting your money back. And then we just closed on a commercial plumbing company last week. And then we also own a striping company that paints lines like a pickleball court or parking lot.
Okay. Yeah, and parking lots and right. Yeah, cool. Interesting.
Yeah, and then we do other debt venture deals. So
What
that's
venture,
a
debt
little
venture?
bit, yeah. Like just if a small business or a business needs a loan, and more so for kind of gap financing versus kind of like I need this chunk. It's more so I need this much to get to this period, and I'll pay you 1 to 1.5% interest a month, and pay you back in 12 months. And it's like, oh, that's a good deal.
Cool. And where does that cash come from? Are you using finance for that as well? Or like, is this just cash that's left
For
in
that debt
Holdco?
financing?
Yeah.
It's coming from all the other businesses. So the dividends and the distributions that we receive.
Right. Cool. There was one question that I wanted to ask around, I've sort of just lost it. I'm sure it's going to come back. It was to do with funding from the Holdco. So you sold the bakery or the catering business, one of them, to fund
Yeah, the catering business. Yep.
Yeah. Yeah. So did you take the cash from the sale and then just put it straight into, or use just cash to fund that? Or did you use the cash to acquire more finance, say SBA, to get more finance to fund expansion of the catering business?
Yeah. So on that one, our CEO, David, he sold the catering business and then essentially used the cash from it, one, to pay off the liabilities that were owed on that business. But then once we had kind of the net proceeds, using that to leverage and buy real estate, in which we were kind of building on next. So that's primarily how it was used, was kind of firming up our kind of balance sheet, and then going out and identifying the properties and being able to move much quicker because we had more cash on hand, which made it more easier for banks to be comfortable with.
Yeah. I just want to explain that, why you, and correct me if I'm wrong, but this is very general terms, but just for people listening, it's a really wise move to go away and purchase the location and own the location and have the business rent the location off the whole holdco, right? It's a really good financial decision versus just finding somewhere to lease, right?
Yep.
Is that sort of the reasoning?
Yeah, there's a couple locations that we lease, but most of the locations we've started to own. And the reason being is it's much like when you own the property, you're not answering to other people. Well, granted, you're answering to banks, but you're not answering to a landlord on what you can and cannot do with respect to a leasehold improvement. And so you can kind of construct what you need for the designated purpose rather than already buying an existing shell or a building and kind of customizing it for what you actually need, but you're not going to get all the utilization out of it because you didn't start from scratch.
Yeah, absolutely. Absolutely. So there's so many things that we could talk about, and we could probably talk for hours and hours and hours. So I'm just trying to select a few questions valuable for the audience. I'm probably going to stick to mostly online businesses and the valuation of online businesses. What are the major differences between valuing, and this is very general, but valuing an offline businesses versus an online business?
Good question, especially as it relates to e-commerce. E-commerce it's very interesting to see kind of the trends of the products being sold through an e-commerce business and where those sales are predominantly coming from. So when you're looking at a brick and mortar business and looking at how our sales generated, where it's coming from, whether it's from the local community or just a general geographic market. But when you have the ability to sell more so nation and international, then it becomes your website, it becomes kind of like your digital location. So you can customize it for what you need. But at the same time, when we're looking at an e-commerce business and assessing value, one of the components is, again, where are sales coming from? One of the aspects that makes a business typically more risky is if they are predominantly selling on Amazon versus through their own website. Because if it's on Amazon, there's more competition.
Yeah, this is the single source dependency on Amazon as well. Like I like to typically tell people are probably sick of hearing me say this on the podcast, is that if you own an Amazon business, technically you don't own the business, Amazon does, because they can just shut down your listing at any time based on them changing their terms of service or policy for what you can or can't write in your listing or images that you have in your listing. It's a tricky one because I'm not sure about the competition in terms of, is there increased competition on Amazon compared to off Amazon? Because it depends on the niche, the industry, the product, and then the players
in your marketing channels
that are off Amazon versus on Amazon as well.
Yeah, it's really a hit or miss. Like we're working with a company that predominantly, they manufacture their own product, which is actually a great moat to have, as they sell it predominantly through their website and online sales and through affiliates. So because they control and have the patents related to their product, it really makes it difficult to compete in the e-commerce space. Granted, what they're making are gun parts to make it more efficient, but they sell it to people all over the country and to different governments. And so they have these contracts, but 90% of their sales comes from website traffic, which is awesome. Which is kind of what you want. You're more willing to buy a business like that because it has a defined moat and product, and the traffic is solid because it's who you want to sell to. It's your right crowd.
Absolutely. And you are not so reliant on Amazon. You can have lesser fees in fulfillment. You can have better cost per acquisition rates. You have own your email list, which is a massive asset. So you can do abandoned cart campaigns, follow-up campaigns, email marketing campaigns for upsells and downsells. You can have upsells and downsells on the website. You can increase your customer lifetime value dramatically. You can even and I've had guests on the podcast talk about taking an e-commerce business and turning it into a membership business instead, say even apparel. For example, you could, every winter or summer, you could get X amount of credits to the latest gear and purchase it, and using that through a membership, or coffee and things like that, instead of one-time product sales, ongoing. It works better with perishables, obviously, like beauty and consumables and stuff like that. But yeah, you're building a far better ecosystem and a brand that you can build that on Amazon, although Amazon, there's so much platform risk on Amazon. And I don't mean to rag on Amazon businesses. If you've got for people starting a business that don't have much experience in marketing, it's easier to start a business and e-commerce brand and put it on Amazon, because Amazon does so much heavy lifting in terms of, or have done so much heavy lifting in terms of, when somebody is on Amazon, the traffic there, their intention is they're on Amazon. What are they going to do? They're going to buy. Right? So they're so much closer to a purchase of a product versus somebody that's on Google that's just searching around and looking, right? And having a bit
100%.
of a... Yeah. So where do people get hung up? Do you have people come to you with e-commerce brands that they want to buy, and they have this ideology of what the business is worth, and then they get a valuation from you, and they're like, oh, interesting. Or they want to sell their business, get a valuation, and they're like, oh, that's not what I expected. So where do people get tripped up on either for a seller or a buyer?
Yeah, normally it comes down to their ability to assess risk. Because ultimately, at the end of the day, the value of any business is what's the cash flow that it's going to generate relative to the risk inherent in achieving that cash flow. And when it comes to e-commerce, some of the key risks are the individual who actually owns it. How involved are they? Are there any employees? If there's no employees, they are the business, which means they understand the customer, they understand and hold the supplier relationship. And so management is key in understanding how easy is it for you to actually step into the seller's shoes and run the business the exact same way and kind of grow it and change it from there. The supplier risk is also a large one is where are you sourcing your product to sell? And if the owner holds that relationship, like we worked with one company where it was very interesting. The supplier was another company in China that the seller owned. And it's like, and the seller was going to keep that company.
Yeah.
And so like in that situation, it creates an awkward kind of point from the perspective of the buyer, because the buyer looks at the primary supplier that supplies 80% of the product, and now the seller can dictate terms because now they're not shelling money back and forth between the two companies. So,
not only
like,
I just want to highlight that as well. I'm glad you brought that up. It's so good. Not only that is that not only can they dictate terms, like the seller, like so they sell the business, they get a bit of cash for it, they own the manufacturing plant in China. They could just cut off, like they could be like, we've got something else that we'll start on the side and just sell our products to out or restart another one, especially in China. Like they don't care.
Yeah.
Like they've got no rules with that sort of stuff. They could just start another same e-commerce brand as what they just sold, cut off the supplier to the business that that person purchased, and then just do it, send it to the other new business that they started. Or they just basically what they do, it's in, if you think about incentive, what's the incentive for the seller who owns the manufacturing plant? Once they sell the business, what's the best move for them to do to grow their business and make more money? It's not the same. It's not in the buyer's best interest. It's the opposite. It's to cut them off. So once you understand incentive like that, the risk becomes more significant, right?
Yeah, it's very interesting to watch because like once we go through supplier risk, we assess customer risk. Like, are you selling to a broad base of individuals, or are there individuals mixed in with like key companies that are buying, like they essentially make up 20% of your revenue? And it's like, okay, like who holds that relationship with those particular customers? And what happens if the seller leaves? Do the customers follow? What if the seller tells that primary customer where they got the product from and give the supplier relationship? And so like customer relationship, supplier relationship, and management are probably like the three biggest overlooked like risk when we're assessing a company. And then we get into all the different risks that everyone else thinks of, like, okay, what's competition? What are the stats behind marketing campaigns and the website? Like, how well are we converting each individual that comes onto our website? Are we using different heat maps? Like, what software is being used to identify and follow the customers through their journey? And where are they getting hung up on? How can we increase, as you said, lifetime value and look at our CAC? Like, all that's important, but that's normally where buyers focus rather than looking at management, supplier, and customer risk first. They like to look at what is currently happening in the operation and what they can change versus what they're buying is an existing business. And you look at the value of that business based on like whether or not it's going to continue in its current trend and not necessarily the changes that you're going to make based on your knowledge and skill set.
I love that you said that, because a buyer is looking at the business through the lens of their own competence. And when they do that, they can focus on, all right, it's being marketed by Google ads. Let's look at the Google ads and see how well they're ran. Can I make those better? And they have blinkers on to like other risks that are in general, far bigger. Like if you think about, when Stephen Covey talks about put the large rocks into the bucket first, focus on the big things. You have the single source. It's basically, we could just call it single source dependency, right? Single source dependency on the key person in the business, single person dependency on a supplier or a customer. And there's no point in that. You should be looking at those first and starting with those first with evaluation before you move into more micro focuses on different parts of the business with marketing and sales and traffic and whatnot.
Yeah.
Right.
Yeah.
Do you notice there's a range? Just for expectations, right? Expectations just kill people. Do you have a range where, is it 10, 20%, 30% that people believe their business is worth 10, 20% more than what it is actually worth for a seller, or a range for a buyer that, do you have any of those stats?
Those are hard. Like, we value 20 to 30 companies a week. And so like, I would say from the perspective of it also depends on, like, is this a seller and a buyer conversing with each other
Yeah.
versus a buyer and a broker with a seller? Like, because ultimately, a seller and a buyer that come together and start chatting, like, they are going to have a lot more differences in value. And so, like, it's very broad. Like, e-commerce and SaaS companies have more divergence in what the asking price is of a business or the purchase price is versus what it actually should be transacting at in order to create a scenario that's fair and reasonable to both buyer and seller. So, like, that's hard to really nail down kind of where, like, a percentage, because we've seen companies that are like, we did a valuation this morning. Granted, it was for brick and mortar, but there were math errors performed to determine the purchase price. And so we came in at a valuation that was less than half of the purchase price. And so, like, and that's just for a normal business. So e-commerce is like, there's a lot more that comes into play. When you're working with a broker, a lot of brokers that we've worked with lately in the e-commerce space like to list the business for as high as possible. And it's not based on what's fair and reasonable for the buyer and seller. It's based off of, if the buyer does this, then this would create more value. So therefore, seller, you should sell the business based on what that number is. Like, you didn't do it, seller. The buyer's going to do it, but let's see if they want it.
Yeah.
So
Yeah.
on those, we always come in under, because it's going to be value creation on the buyer side. So I know I didn't answer your question.
No, but it helps though. It helps.
It's hard. Yeah.
Yeah. Yeah. It just means that when, say, we've got people listening that are selling their business, if the buyer it's going to be a strategic acquisition for them. For example, it's in the same niche and they can merge the business with their primary business. Typically, that you would see that you could maybe get more than if you were selling it to a single investor that's just one acquisition in their portfolio, separate to everything else, right?
Yeah, like, one of the ways to think about it is, if you're the one selling, like, put yourself in the shoes of the buyer. Like, if you were selling the business at that price today as the buyer, would you buy your own business at that price, knowing what you know?
Yeah.
Most sellers quickly say yes, but the sellers that actually stop and think and go through, like, probably not. It's like, okay, then why are you trying to sell it at that price?
Yeah. Yeah. That's a really good few questions to be asking. So I want to chat about SBA valuations, because a lot of people are going to be wanting to acquire an e-commerce business or a SaaS business using SBA. So you do SBA valuations. I'm assuming you doing those for the banks. Is that right?
Correct. Yep.
Yeah. Okay. So if that's the case, what are some of the things that buyers need to know when assessing a business and they want to buy it using SBA? So the question is, how do you value the business for an SBA loan? What are some of the things that, let's just stick with e-commerce versus SaaS first, but like,
Yeah.
what,
Well, yeah, so I'll touch on that before you ask more follow-up questions. Ultimately, the valuation process is still the same, whether it's for an SBA lender or for two individuals buying and selling a business. Where the primary piece comes into play, if you're the buyer of an e-commerce business, is identifying an SBA lender and bank that actually understands e-commerce and how that works. That's one of the primary areas of concern generally, is there's SBA lenders that are lending to e-commerce that don't understand e-commerce. And so when it gets closer to the finish line, it ends up failing because
all the terms aren't
everyone
great.
Yeah. So that's the first key. Because from a business valuation standpoint, it's all pretty much the same to some degree. Just our client at this point is the bank. And so if you find an SBA lender that understands e-commerce and lending to e-commerce and what makes your business model more unique, whether you actually hold the inventory or it's more of a drop shipping model where you don't have inventory, like, there's clear distinctions in e-commerce that make it more unique than a traditional business. So, yeah, does that answer what you wanted?
Yeah, no, that's great. I'll dig into more. I just want to put a bit of a note here for people listening is that if you are looking at buying an e-commerce business or a SaaS business and you want to use SBA, reach out. I have some people that I can send to you depending on the size of business you want to purchase and the model that you want to purchase. Info at buyingonlinebusiness.com. I can just refer you to some of those. Now, what are some of the things that a buyer should be wary of when buying a business using SBA?
So one of the key kind of pain points that we've been coming across is understanding working capital.
Mm.
Because ultimately, like every business that's currently operating, yeah.
Yeah, do you want
What's
to
your
explain
question, Jaryd?
working capital? Yeah, just so people can,
Yeah.
because you're a
So,
CPA, right? Like you've got all these accreditations for this.
well, yeah. I used to be a CPA. After not practicing for 9 years, I gave it up. But essentially, working capital is the necessary kind of funds you have on hand to keep the current business operating as is. And so as your business grows, you need more capital to fund that growth. So with a traditional business, like the simple equation is your current assets, so your cash, receivables, and inventory, minus your current liabilities, so your accrued payables, your credit cards, and ultimately you take current assets minus current liabilities, and that shows what working capital is. But if you want to get more granular, like the better equation generally is to look at all the expenses that the company is incurring on a daily basis, or you could look at it on an annual basis, but divide by days to get to daily basis. Mm-hmm. And that gives you an idea of this is how much money we spend per day to keep this business currently operating, and doing some industry analysis to figure out like how much working capital do we need to actually have on hand in order to generate these current revenues of the business. So most individuals selling businesses will extract all the working capital out of a business and require the buyer to bring their own working capital to keep the business going. And that actually hurts the valuation on our end, because if the buyer's required to bring their own capital, generally they're getting a loan to do that. Mm-hmm. And now they have more debt that they have to cover themselves. And they're trying to fuel a business and keep it running with little, like if they haven't figured out working capital before they transact. And that's what a good SBA lender will do. They will help you understand what your working capital requirement is to kind of sustain it and keep it going. And like, yeah, that's like one of the primary components that we've been having more issues with any type of business model. E-commerce is an interesting one because if you have inventory on hand, like you need some of that inventory to operate as is, but most of that inventory is what we call excess inventory. It's inventory that was pre-purchased that doesn't necessarily have a purpose in its current standing. And so that is kind of additive and it increases the value of the business.
What type of working capital, how much working capital do SBA like to see? We're talking 6 months, a year. Like what's the minimum you typically?
Yeah. So it really depends on kind of what the industry is. So for instance, like a restaurant, for instance, has a really short lifespan of working capital needs because it's just churn and burn. It's just cash in, cash out. And that time frame is generally like 7 days. Whereas other businesses, e-commerce is probably closer to anywhere between 20 and 30 days to like a month on hand of working capital. And it kind of skyrockets from there because there's some businesses, like we're working with a business that sells online, like they kind of cross into the online jewelry store space, but they primarily deal with bullion gold. And like that holding period is 75 days.
Yeah.
And so significantly longer because your inventory, like you need more inventory on hand in order to service all your clientele because you don't know what they want. Whereas if you're kind of one silo, like this is our product offering, you could have it much quicker, especially if you know kind of from a sourcing standpoint, like if I were to sell this inventory item today, like a mouse, for instance, like a computer mouse, like how long does it take to get a mouse already ordered so I can ship another one? and just understanding kind of what that cycle is, your cash cycle. And if you're able to turn that mouse into cash, buy a mouse and sell it again, and it takes 8 days, like essentially 8 days of working capital to kind of sustain current operations. If you're trying to scale, you want more cash to buy more inventory so that you can ultimately kind of be able to ramp up and sell more inventory, kind of like the holidays. Everyone ramps up in September and October from a buying perspective because they know they're going to sell November, December, and those are their big months. And then it kind of goes like e-commerce is fun space to work in when looking at a business because it's all cyclical. It's not consistent. It's understanding the seasonality and where the trends are. So
I love that. So working capital for e-commerce businesses can be anywhere from 2 weeks to a month sort of thing, right?
Yeah.
Now, what about, that's very general. That's going to be dependent on the business a lot. These are funds that the buyer is going to need to have. So basically, I would say I like to have more than 6 months working capital in my business personally, far more.
Nice.
For each business.
I'm the same way.
Yeah.
So
I mean, people call it like a war chest. Same with like any investment is like that costs, it can be profitable, right? Like a property investment, but I like to have a year, 6 months to a year of working capital. What about a SaaS business? Is it pretty similar? Like, would you say 2 weeks to 4 weeks sort of thing?
SaaS ranges so drastically. So it all depends on the business model. Like, is it actually generating revenue?
Yeah.
But if it's not generating revenue, like, it's a matter of where's the cash coming from to kind of have working capital to pay your employees in the technology. And so, yeah, like that one I don't have a pulse on because the SaaS company that we worked with and delivered a valuation report last Friday, like it was, what did we use? Here, let me look it up.
Sure.
Yeah, so looking at kind of our quick stats and our project management, like the net working capital percentage used as a percentage of revenue was 30%. And so what that equates to from a day's working capital, I honestly don't know, but 30% of revenue when you're doing, I think they were doing 3 million in revenue, like that means you have to have 900 grand on hand.
Yeah.
As working capital. That's a lot.
Yeah.
So most people don't have that, but ultimately they were on a ramp up stage from a growth perspective because they were growing between 30 and 42% year over year for the last 4 years. And so based on that growth, they were essentially just keeping, like, they needed the working capital to continue that growth moving forward. That's why a lot of SaaS companies, when they raise venture capital, they want that war chest as big as possible in order to prolong their growth cycle.
To continue that growth. For example, say you acquire a business that's got 20% year-on-year growth the last 2 years. You want to be able to at least maintain that 20% growth by spending the same amount of money. Likely most people are going to want to double it, so you're going to have to increase your working capital or have more working capital to grow it. But also you're going to probably need around that 20% enough for working capital for the SBA to approve the financing for the business anyway, right? Yeah. Cool. I love it. So a lot of people are probably going to be thinking about reaching out to you now for some valuations. So you help buyers, you help sellers, you help people that are in the middle of a trend, like looking at a transaction. What percentage of people come to you as a seller, a buyer, or about to transact, or in the middle of a transaction? What in online, in say e-commerce and SaaS?
Yeah, so from a workload perspective on our end, I would say half of our valuation work is associated with SBA lenders, where the bank is ordering the valuation.
Amazing.
Then about 30%, so another like 12 to 15 valuations a week are somehow related to a seller and a buyer kind of transacting by themselves. And then outside of that, we deal a lot with partnership disputes and divorces.
I bet. Yeah, I bet.
So those are fun. They're a different type of transaction because there's lawyers.
They're fun because they're more dramatic, right?
Yep.
I love it. All right. Well, thank you so much, Ryan, for coming on. Is there anything that you think I should have asked that I didn't ask?
Valuation is very complex. So, like as you stated earlier in the conversation, like we could chat for hours because there's so many little kind of, oh, this is weird, like questions where it's like, oh, I never thought about that. Or like when you're looking at a valuation multiple, like what does a multiple actually represent? Most people just look at kind of what they can find online without understanding that it's a measure of risk return reward that a buyer and seller kind of agreed to. And so like when you're looking at e-commerce or SaaS, like those are two industries where the multiples just, instead of being here, they're like here.
Mm-hmm.
So like they range drastically depending on risk, growth, demographic, and what's happening in the business. Like all the qualitative factors help us translate. I would assume in your case too, like qualitative helps us understand the financial aspects of the business, which ultimately results in this is what you should be transacting at, and this is the implied multiple as a result. But you've asked great questions. There's obviously so many more questions we could go over, but
Yeah.
that's for another day.
Thank you. Yeah, I mean, just to add to what you said, is that when somebody's looking at buying a business and maybe they bought one or two businesses, maybe they bought three businesses, maybe they're kind of like know a fair bit about business, but if they're not in the market, and this is going to be most people buying a business, the first or second business, if they're not in the market of the business model that they're purchasing and the industry or niche that they're purchasing in, how are they going to be able to know the comparables of that business model at that price range in that specific niche? They just don't have the data. They're not in the market looking at those businesses all the time, which is where your value comes in, is that you're in the market for a broad spectrum of all different types of businesses, business models, niches, industries, plus the price range. Like the value of a business that goes for maybe like a couple $100,000 versus something that goes for a couple of $1 million, the multiples can be very, very different. I'm not saying they will
Yep.
be, but they can be very, very different based on the type of business model, the industry. So that's why it's so hard for somebody that's investing. Even if they've bought two businesses themselves, they're not spending all day, every day in the market knowing what the market value is. So that's why
Yeah.
it's worth reaching out to Ryan, guys. So Ryan, where should we send people to check out more about what you guys are doing?
Yeah. So our website is a great spot. We focus a lot on education. So PEAK, businessvaluation.com is a great way to kind of learn more about what we do. Or you could just call our office, and I'm usually the first person that picks up. You could reach me at 435-359-2684 or email. I live in email. So Ryan at peakbusinessvaluation.com.
Awesome. Well, it's dangerous giving your phone number, but you'll be getting some calls.
Yeah, that's fine. We get about 50 to 60 inquiries a week.
Great.
So I'm happy. I like chatting with people. It's fun.
Awesome. Yeah. Well, thank you so much for coming on and spending your time chatting. Really appreciate you, Ryan. And everybody who's listening, thank you for listening. And I'll see you on the next one.
Okay. Thanks, Jaryd.